Welcome to Power Charting. I am your host, Bruce Fraser. Tight money timing. Talked about tight money timing in the past. Very important. Easy money tends to be associated with bull markets and stocks. Tight money tends to eventually become a drag on stock prices and can lead to a bear market. Also, today we're going to talk about more green shoots. We introduced the subject last time. Go check that out. And also, we introduced Power Charting Trend Model, and we are going to revisit that with the time that we have left. So let's move on. Let me tell you about the Wyckoff market discussion, wyckoffanalytics.com. We had a great session yesterday, Roman and I. It's fresh out of the oven. It's still warm. Go check it out. You can go to wyckoffanalytics.com, watch the recording. It's all things markets from a Wyckoffian perspective. We had a really great time. So please check it out at your leisure. Now, let's start here with this chart. I've shown you the chart on the left a number of times now, but let's just look at 20-year US Treasury Bond ETF point and figure study here on the right briefly. This here is the top of the bull market in the long-term US Treasury bond. We take account across this area with a high price of 152, and it counts down to 101 to 91. Well, here we are. We're in that price zone. Who would have thought that we could get from 152 on US Treasury bonds down to under 100? But here we are at around 96. Also, we have a redistribution count, 9 columns across, that counts down to 93. So we have here across this area first a stepping stone redistribution and a confirming count, because the 93 nests in the 101-91 area. Very interesting. Now, what we need to see, this is not a reason to buy bonds. This is a time to start to look for the effects of stopping action and cause building, either for a new redistribution or potentially accumulation for a rise in prices. So too early to tell at this point, but we're going to be watching very, very closely. Now, let's look at, let me get my little pen here. This chart on the left, we've looked at this a number of times, and this area right here, this is the US Treasury 10-year to 2-year yield curve chart. And so when the yield curve is flattening, that tends to be a tight money environment, and tight money eventually becomes a drag for stock prices. So a positive yield curve, which is anything above the yellow shaded area, typically represents a benign to positive environment for stocks. Here's a very steep yield curve here. Here's a flattening yield curve here. So keeping that in mind, let's now turn to the more important yield curve relationship, which is the 10-year to 3-month Treasury note to bill relationship. This chart, as you can see, in 2019, this area here went into a negative yield curve situation. But the interesting thing is in both of these examples, yields were falling. Typically, a falling yield environment is a favorable environment for the economy and for stocks. So, in fact, this was a relatively benign area, but we did get the COVID decline here in the first quarter of 2020. So later on, after this area, we did have a very sharp decline in the stock market. Well, now, what do we have going on now? We have interest rates, this is the 10-year, rising precipitously, and now we have the T-bill starting in 2022 rising at a very fast clip. Well, note here, right in that area there, that we flirted with a negative yield curve 10-year to 3-month just yesterday, Wednesday, October, well, it was October 19th. And so now we are right at the zero line, a completely flat yield curve. This is an environment where we have two things working against us. We have a steeply flattening yield curve, and we now have a yield curve that is borderline negative. And so this tends to be a drag for stocks, a drag for the economy. And in fact, as we can see, the economy is arguably not growing at all right now, or at a very, very slow clip. Now, let's turn around and let's go to this Fed funds chart. And this is a very interesting chart from a couple different perspectives. First of all, I've encompassed a period of time that includes two big bear markets here and here. And then also we must consider this to be a bear market environment and potentially the COVID drop, which was significant. And so we have some areas here that we can study relative to interest rates. And so let's look at the first bear market, which was 2000 to 2002. And here I've highlighted in yellow the bear market period in the S&P 500. And note that if you look at, now let me explain this chart. The black line is the Fed funds, Fed rate, we call it. And that is a $ Fed rate. And note that the Fed rate is significantly above the US Treasury 2-year. And so this actually demonstrates the spread between this high and this high, that the Fed is actually pretty tight because they've actually got the risk-free rate even above the 2-year rate. So note that as the bear market starts, and it was a significant bear market, even worse in the NASDAQ stocks, that the Fed immediately stopped raising rates, went into a interest rate posture of not raising, and then started to aggressively lower rates all the way into 2003, and then kept them at a very low level for quite a long period of time. But the bear market that started continued to go down, even with the Fed lowering rates at an aggressive posture, or being very accommodative. And so now let's look at the next bear market. This is the Great Recession bear market. And what I've done is I'm showing the yellow area here. But note that if you look closely, two things are at work here. This area, the Fed stops raising rates here during the last leg of the bull. And then they go into a posture of waiting, and they're way above the 2-year US Treasury yield. So the Fed is in a tight posture. They have a Fed rate that is well above the 2-year rate, and a bear market begins. And as soon as the bear market begins, the Fed starts to lower rates and keeps lowering them all the way through the bear market. So the Fed, even though they started from a rather, call it hostile position, they started to lower rates as soon as they saw that a bear market was underway. Now, what is different about well, let's take one quick look at the COVID period. So COVID, you can see that the Fed stopped raising rates at about where the 2-year rate was for the US Treasury. And so not particularly hostile. They were both at roughly the same level. And then they kept rates steady and then started to drop rates as we were starting to see the final period of and actually you can see here, let me see if I can draw this, right through this area right here. Even though the stock market was going up, the Fed was lowering rates. And so this was, the Fed was already starting to lower rates and lowered them all the way through the COVID decline, and then kept them at a very low level throughout, as there was a tremendous bull market run out post-COVID. How is the current situation different? Well, it is different. And so let's just take a look at this. Let me get my highlighter. You can see that, again, the Fed funds is below the 2-year yield for US Treasuries, which I would argue that being below, unlike here where it was above, being below suggests that the Fed is still very accommodative because they are not yet up to where the 2-year yield is. And so if we look at the bear market, the Fed, and let me go back out here, the Fed is raising rates all the way through this period as the bear market is underway. Each of these three scenarios with the green down arrow shows the Fed lowering rates as the bear market gets underway. Very interesting. Today, completely different situation. The Fed is raising rates and does not yet have rates up to the level of the US Treasury 2-year yield. And so they are arguably too accommodative according to this chart. And past performance suggests that they will get rates above or at least to the US Treasury. So they have further to go in their rate tightening. And now you can see that we have a bear market underway, but unlike in the past, a bear market that's accompanied by the Fed continuing to tighten, largely because of inflation pressures. So anyway, this is a different kind of a bear market than the prior three that we saw, especially from the relationship of the Fed. I want you to keep that in mind because this is the environment that we are operating in the stock market at this time and likely into the future. So, and here you can see this red line, red arrow showing bear market down in stock prices and continuing to see too accommodative of a posture in the Fed. They have further to go to catch up with the 2-year, and rates are likely to keep going up. So what does that argue for the potential future for the stock market? Now, with that, you've seen this chart a number of times. This is a trend chart. And here, this is just to show on the S&P 500 that we continue to be just below the secular bull market trend, which is at risk at this time. And we want to see if it can get back up into this area. Interestingly, and I just want to point this out, lower low in the S&P here, higher low in this 3-month rate of change. So, and also from an oversold condition. And so that's something for us to keep an eye on, whether or not that could give us some kind of a relief rally in this ongoing bear market that we've been in. Now, this is a chart we haven't looked at for a long time. These notes over here are old notes, but this is a secular uptrend in the Dow Jones Industrial average. Each of these trend lines is drawn based on its own stride, and you can see that they are parallel effectively, but they are both legitimate, a supply line and a demand line underneath, and we are right down into the area of the demand line. And note, let me just blow this up real quick. Note that we are seeing a monthly bar in the Dow Jones that is rallying off of this demand trend line. And so this is very interesting. Could we have some kind of a relief rally into the channel? And the Dow is showing us that that is entirely possible. So here's the NASDAQ 100. As you can see, we've looked at this chart just last week, actually, so I'm not going to spend much time on it, but oversold at the demand line right here, all the way back to 2011, like was the case with the S&P and the Dow. and we'll see whether or not it can rally up. Sentiment, pessimism in the long-term put call is also reaching extremes of pessimism, which is a contrary opinion indicator. Okay, another chart. We haven't looked at this chart in a while. I think I wrote a blog on this back here, and we got a great distributional count in this area on the UUP, and it counted down to the lows, which also is a very important demand trend line drawn off the 2014 low and the 2018 low. And look at how it just touched it beautifully a few times. And then this monster rally back up to the overbought level, and which it touched beautifully. And you can see that it reacted quite sharply off of this overbought level. I believe that the dollar is in a trading range. Potentially, it could even have more of a correction off of that level, but I think we've had a buying climax, automatic reaction. Pull up a daily chart and do this work and have an analysis of that area. I think it's so interesting. But there's a reason I'm showing you this chart right now, and let's go right to it. Here's the China fund. Oh, let's go back, and let me point out this low right here was at the beginning of 2021. So the low in the dollar, which there was a distribution count that went right to that level, which was also a beautiful demand line. That level right there at the beginning of 2021 kicked off this monster rally in the dollar. Now let's look at the China fund, CHN, and look at the overbought condition back to 2004. These are the anchor points, 2004, 05. These are monthly bars. Here is the overarching supply line, reverse use of trend lines, throws over, overbought, beautiful, right at that level. Well, look, that's the low for the dollar on the prior chart. And the dollar goes into that immense upward stride as the China fund is going into an ever increasing acceleration, now into an oversold condition at the bottom of the channel. Very interesting. I would expect, as was the case here and here, that if this low holds at this level, which also is an oversold condition on the 12-month rate of change, that there will be a cause build. It won't just start to turn up typically, but will build a cause like it did here, built a little cause here and here and here and here. So we will watch this closely, but this looks like an acceleration with a climactic bent to it, and we will see whether or not the dollar stalls here and the China fund can also find some kind of a low. And now here is the FXI, which is the China large cap. And note here, this is a chart we looked at a long time ago. And here we have an anchor point, touched here, and then fell out here. And look at this big decline that we've had. And what I really want to point out is here's the FXI SPX, S&P 500 rate of change. And this is monthly. But note how this is just down, down, down. The moving average just continues to be weak all the way through, and the trend is down. And in fact, this is an underperforming asset class, at least in the US dollar, really going back all the way back to 2009, 2010. All right, now let's get to green shoots as we run out of time. This is just interesting from the perspective that this is the NASDAQ percent of stocks above their 50-day moving average. We talked about this before, downside non-confirmation, lower low in the NDX, higher low in the NASDAQ composite stocks in aggregate. Remember, one stock, one vote. Here, this is market cap weighted. So we have the large number of stocks starting to inch up. Fewer stocks are going down from an extremely oversold level. Around 10% of stocks are above their 50-day as a measure of a trend. This resulted in a rally in June to August. Now we have something going on here where we have a period of higher lows being made, lower lows in the NDX, downside non-confirmation in the 50-day. let's go to the right here. This is so interesting because this is the 200-day. As you can imagine, the NASDAQ stocks, the 200-day moving average would be slower, would tend to confirm at a slower clip. But look what's happening. The June low and now the September low, this is higher while the NASDAQ comp is lower. So downside non-confirmation of the 200-day moving average of stocks. Below 10% at this level right here, extremely oversold, slightly below 15% here at the September low. Is there internal improvement or healing taking place in the NASDAQ stocks underneath the surface? And so that's the question that we ask here. And also look at the 200-day on the near term from the end of the quarter, end of September, higher lows throughout as the NASDAQ comp index is making lower lows. Fascinating. Okay, let's hurry on here. And we have, I want to show you, let's look at this chart. This is gold. And again, this is the bear market top in 2022, a bear market top, local. And you can see this count across here takes us down to this area of 1680, 1610. We are in that area now, and there tends to be some attempts at showing strength and trying to stop the decline, need to build a cause if there's going to be one in gold. Interesting because we are fulfilling counts here. Here is silver futures. Here is a distributional count in early 21. Counts down to the area that we're at now, which is 17 up to 1950 on the silver futures. And it looks as though a cause is attempting to be built. Redistribution count confirms that 17 area, slightly lower. Maybe we get a spring into this zone right here. But anyway, one to watch, interesting. Now, let's turn our attention to industry groups in the time that we have left, and we will pick this up next time and go into much more detail. But this actually is a measure of oversold. 112 industry groups, and I will show you how you can drill in and see those. Matter of fact, I'll do it right now. But there's only 9 groups that are in the power charting trend model uptrend. And I'll show you how to do that. I talked about it some last week. We'll get into it more next week. This is a great way to see where leadership is emerging. And when we're in a bear market, we want to see where the early leadership is. And so we're going to learn how to do that with this tool. So, but this is a very, very low reading. When you're in a bull market, you can have 60 to 70+% of industry groups in an uptrend on our power charting trend model. So very wide breadth of leadership, both price and relative strength. In a bear market, it's going to be typically low. This is very low, under 10, well under 10%. And so this is a way for us to see where the breadth is, and also note the industry groups that are acting well. They're mostly energy, and even marine transport is energy. Heavy construction, defense, property casualty insurance are differing areas, and those are interesting. And then I also have the dollar in here. So you can see that one doesn't count. That's the reason we say 9 instead of 10 on this list. Okay, so and then here is our trend model. Talked about that last time. We will talk about it again next time as we go. This is our case study. But what I really would like to do is I would like to take a few minutes and go through the industry group list from the table perspective. And what you do to get there is you go charting tools, charts and tools, industry summary over here, and then you get a chart view, which is interesting. I like the table view, and then I sort by the scooters. And so strongest to weakest. This is a really cool, fast way to get to leadership, especially in a bear market. So now you can see all the industry groups by sector, and note that the energy sector has, except for pipelines, everything's in the 90s for the energy sector. Financial is an interesting place. Let's do the scooter rank here. Life insurance. Remember how we said life insurance and property casualty were at the top? Well, property casualty is 88, life insurance is 90. There's some leadership in those stocks in those groups. All you have to do to go in and look at the individual stocks is click on the name of the group. Now, what I do, and I only have 30 seconds left, is I go to this button here, click on it of the little chart icon, and automatically my chart goes to my power charting trend model schematic. So you can see life insurance here. Well, look, life insurance is below, it's declining 39, but it's knocking on the door. And so it's ready to turn up and potentially turn off my timer. And you can see the relative strength down here is already ripping. Talk all about this next time. I'm so glad you were here. Thank you for being on with me on power charting, and we will see you in a week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.